Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It's Friday morning, the 13th of June, and we've already overnight had more geopolitical developments in terms of Israel's attack on Iran and the killing of the head of the Revolutionary Guard. So clearly, geopolitics are dialing up a notch, and that will affect some of the stats I use in this podcast, in particular around the oil price, which just as we record is now up at $73 a barrel on the back of some of these tensions in the Middle East. We clearly have had other geopolitical developments, the air crash in India, which affected the price of Boeing, and we are continuing to work our way through trade negotiations. So a busy week in terms of news flow, CPI data, and stock price movement. So let's move on and look at the slides. So we're recording this, as I said, close to the middle of the summer. Typically, this would be a time when we have some kind of reprieve. We have people taking vacations. A little bit less focus on markets tends to have lower volatility, lower liquidity. So we are having a little bit of a reprieve in the movement of equities, the movement of bonds, not, however, for the dollar, which is definitely in a weaker spot this year than it would have been this time last year. And we do see it in a somewhat steady decline as we see the technical factors affecting the demand for the dollar, as well as perhaps some concern around the erosion of the US exceptionalism thesis. So that is the one area that there's no reprieve for, it seems. And what we can see is a series of counter narratives emerging. We've heard narratives around consumer sentiment, which seem to diverge. We've seen narratives around inflation, which seem to diverge, and equally around the US exceptionalism versus potential for quite strong growth in Europe. There's been a bit of two sides of that debate we've seen discussed this week. There is a focus on deals when it comes to, say, US and China, a bit of emergence of some form of progress when it comes to both precious earth minerals as well as tariffs on China that seem to boost markets somewhat. However, though, the story of markets continues to be their resilience. And just in the line of these counter narratives I mentioned, the question is there any downside to resilience? Does resilience and the fact that markets seem to be able to remain positive, remain strong, despite a series of own goals, perhaps, when it comes to tariffs or even geopolitical stresses, does this mean that policymakers feel emboldened to make ever more dramatic moves or changes when it comes to policy because essentially markets seem to be resilient despite it all? So we will look a little bit at the downside of resilience. I've spoken already about the introduction of dollar demise as a factor. It's not a new introduction, but it is becoming an increasingly important factor in the management of portfolios, particularly for non-US investors. A suggestion even that all fund managers now need to be currency managers. And then finally, portfolio implications just like that we have coming out of some of the market developments this week. As I mentioned, counter narratives seem to be the order of the day. Despite tariff fears, we have seen more muted inflation numbers. Consumer prices rising 2.4% over the year in the US, with lower than expected month-over-month increases. Those month-on-month increases well south of 1%. That has even given rise to increased pressure on the Fed to decrease rates. And even one of the administration, the vice president, even went so far as to suggest that not decreasing rates, not easing monetary policy, represented a form of monetary malpractice. So we are definitely likely to see emboldened demands for the Fed to join the other central banks around the world in dropping rates now that inflation seems to be so muted. However, it is important to note that the muted effect of inflation is probably not yet taking into effect tariffs. We know that tariffs are set to be reinstated after the 90-day period expires. So really, we haven't had any experience of tariffs in prices or in inflation just yet. Just to look on the right in terms of what were some of the 1 month changes in consumer prices, where do we see the biggest increase? Interestingly, food has featured across the board, as well as major appliances. Major appliances, of course, being part of those complex supply chains whereby steel and other imports, definitely from China and other external nations, they would be affected by tariffs. And we maybe are seeing a little bit of that factor in. Looking through rental cars, trucks, where we're seeing decliners, new cars continue to be on the decline. Core and very high profile items such as milk and eggs and gasoline, as well as airfares on the decline. Some of that probably related to the persistently weaker oil price in relative terms. And when we look at what actually the shape of the inflation curve, we can see that core inflation has been heading down. That is stripping out the effect of energy and food. And then even with food in effect, we can see that the overall inflation rate down at 2.4%, core at 2.8%, definitely coming down the mountain, heading in the right direction. But that is in the aftermath of COVID, not necessarily taking into effect tariffs. When it comes to then whether inflation is well under control, we can actually see that in Europe, they may be looking at a whole new set of problems. For years pre-COVID, we were discussing the potential Japanification of Europe and even the US at some point. There was a suggestion that whereas Japan had persistent low levels of inflation, even at deflationary levels, that this deflationary effect was actually a far worse problem, in that we would not see asset prices growing, we would see that contracting, and it was essentially quite a trap in terms of this deflationary effect from prices falling, and really just not a pro-growth orientation at all. What this seems to be raising its head a little bit in Europe, suggesting that the rate cut is in order to ensure that inflation will not settle below target. So in effect, this monetary policy being used in Europe as it was originally intended, to stimulate consumer demand and ensure that spending still continues to happen. That is, of course, a difficult transmission effect to engineer. We know in the past that consumers, particularly consumers that are aging, perhaps less filled with buoyant sentiment, more prone to saving, as many European consumers are, it is difficult to force them to spend, particularly when we have uncertainty enshrouding markets and some of the outlook. Remembering that in Europe, there is uncertainty still around the supply of energy. We know that energy prices have been high in the winters before. We're now in the summer. Perhaps the specter of higher energy prices in the winter could put a brake on spending. So that and the potential for inflation to be too low is very much something that is on the minds of European policymakers. Not the issue we've had in the US, but definitely still something to bear in mind. And why is this deflation such a concern? Really because we have the sense that the Brent is unlikely to hold around $70 post-summer. Right now, it's, as I said, it's $73, but there is some concern that with supply and other issues that we're likely to see Brent falling low, and that would then contribute to more disinflation. Where are we seeing areas that inflation is, however, somewhat strong? It's in services. Inflation continues to be the core contribution to CPI, and core goods themselves are still rising. So inflation is always a mixed picture. We don't have a clear direction of travel. Despite the fact that airfares, for example, were lower, we know that services continue to be somewhat stubborn, more of a lagging indicator. And that's why perhaps the Fed is not yet too complacent about inflation being in the rearview mirror. Looking at other economic data, not much this week in terms of sentiment or hard data, but we can see that continuing claims for unemployment benefits have been the highest since late 2021. So not a particularly buoyant picture on behalf of employment there, but we are still having quite a bit of mixed indicators when it comes to soft and hard indicators. So for now, pending more resolution around tariffs, a bit of uncertainty prevails, but the market is tentatively holding it together, at least in the US, in terms of the economic indicators. When it comes to bonds and movements, I'd say we have rates on the move here. The bond movie before, again, is a quote from the Wall Street Journal here. We know that we have rates, 30-year rates, both in the UK, the US, and Japan, all heading into higher yield territory. In the UK, they're north of 5%. In the US, they're just flirting with 5%, having slightly tipped over there before. Japan still persistently lower, around about 3%. However, we do know that in Japan, that's been persistently lower for some time. But this direction of travel, we know that the bond market is still that market that will be likely to spook the president. And when we see the bond market heading in this direction, we know that there is still some concern around budget deficits, some concern around fiat currency, and this will still lead to perhaps a second guessing of the Fed, but for now, reasonably decent yields in fixed income investments. When it comes to interest rate cuts, we can see that interest rate expectations remain at having one cut in September and maybe one cut in December. This has been pretty consistent around 2 cuts. Certainly, if we look back to May, that was when we were down at 4 cuts. We've come a long way since then, post-inauguration day. The Fed seems to be very disciplined, very data dependent, not yielding to pressure, despite accusations of monetary malpractice, and still seeking to stay the course. We can see that this will stand in stark contrast to the ECB, which has had 8 rate cuts, and the Bank of England, which has had 4 cuts out of the last 7 meetings. If we look at where equity markets are, the story of the month of May and early June has really very much equity markets coming back into the black. And Trump 2.0 finally, after quite a tumultuous start, now ahead of where it was at the inauguration. The rest of the world, however, as depicted by the black line here, the FTSE All World, excluding the US, showing a similar pattern, definitely did dip in sympathy around the time of inauguration day, but the rest of the US staunchly outperforming the US at the moment and outperforming the S&P. But as far as in absolute terms, the S&P in itself is up since inauguration day. And when we look at valuations, some analysis in Bloomberg this week around what is the bottom-up price target of the S&P, and is that heading up, is that heading down? And the bottom-up price target seems to be recovering, which would be a sign that there is general sentiment improving, or a sense that some of the negative implications of tariffs had already been worked into the system. As I mentioned, geopolitics have been quite active this particular week. We are seeing still quite a bit of partisan debate around tariffs, a suggestion even by the Treasury Secretary that there was some sense of angst on the part of the opposition that tariffs had not caused more inflation. And Besant referred to this as tariff derangement syndrome. I would say when it comes to the effects of tariffs and inflation, the real answer is we just don't know yet. We have not actually had a chance with actual tariffs in effect to see their effect in inflation. There was the pre-buying of goods, as we know, in the first quarter, which distorted first quarter GDP in the US. That probably distorted the actual effect of price rises. We know with a bit of inventory hoarding that many companies would be able to desist from raising prices immediately and passing those through to consumers. So I'd say it's far too early to say whether tariffs have an effect gone into effect. A lot of excitement around a UK-US trade deal that is likely to go into effect within days. And then staying in the UK, that is of course where the Chinese-US trade negotiations were occurring. And there was some positive news flow out of that during the week, which seemed to boost markets. However, just at the same time as that positive news flow was emerging around China, we had a suggestion that we would be back to square one, essentially, with tariffs at the expiration of the 90-day period. So quite a bit of uncertainty still in that. And then finally, another data point around the UK, GDP negative there in April, 0.3%, a continuing reminder of just how close the UK economy seems to flirt with stagflation. We know from last week's podcast that inflation there was at 3.5%, bucking the trend of what we're seeing in Europe and the US, just mentioned. But clearly economic growth has been difficult to get started in the UK. We know they're dealing with a challenging austerity situation and the need perhaps to raise taxes. We know there's not tremendous confidence in that market in terms of demand for equities, for bonds. So seeing a negative GDP hit in April, not particularly good news. And continuing the theme of not particularly good news, we've seen a lot of headlines this week around the dollar sinking to a 3-year low on the Trump tariff threat. We're also seeing this really is directly related to this discussion of tariffs, almost one-for-one correlation between tariff discussions and dollar weakness. We've seen, if we look at the chart, how it has renewed its slide, and equally how now, from a portfolio standpoint, the dollar weakness is starting to work its way into portfolio management. We know that many US investors will have a dominant position in the dollar, that will of course be weaker from in terms of spending power, but it works well for the US investor that is invested outside the US. The emerging market currencies, developed market currencies will have strengthened relative to the dollar, so that will boost their outperformance, which we showed before in terms of their equity market performance. When we look though at the dollar for non-US investors, that is a concern, and there is a need for managers to start to think about hedging. And of course, when hedging takes place, that in effect, it has a compounding effect on the weakness of the dollar, because the hedging will involve a form of selling of the dollar, and this is therefore locking in of those rates. This is going to have a compounded effect on dollar weakness. So the more the world decides now is the right time to hedge against dollar weakness, in effect, the more self-fulfilling that prophecy will be. I thought it's an interesting chart here presented by the ECB in terms of what is the most important reserve asset for central banks. We had previously seen the US dollar remains dominant in terms of a central bank holding, a little bit lower than before, probably on the back of weakness, probably on the back of an unraveling of US exceptionalism. And the euro did have a somewhat stable but now falling use in terms of a reserve. What we can see, though, is that other currencies, perhaps the yuan, perhaps other Swiss franc as an example, other so-called safety currencies, but gold now has become the second most important reserve asset for central banks. The dollar remains the most important, then followed by gold, followed by the euro, and then followed by other currencies. And gold itself continues to surge. This has been the story very much of the last few years, certainly in 2025 when we started to discuss the tariffs, the unraveling of US exceptionalism, and a rising concern as expressed in the bond market around the budget deficit. As the dollar has weakened, so has gold price surge. So we're seeing quite a bit of continued strength in that. And then just to shift gears, so just very slightly for the last comment, we have been spending some time looking at private equity and wondering just how these private assets are faring without having the daily check-in of market liquidity and market strength as a barometer. It's interesting to compare just how some market factors are affecting private equity. We can see that the absence of exits, the uncertainty that's prevailing, has been affecting the distributions coming off some of the vintages in private equity. I thought this chart from PitchBook was quite sobering in terms of the distributions to paid-in capital by vintage. We would expect that more distributions would come to the earlier vintages. This is typically when investments mature and when we start to see the sale. So it's not surprising to see far more distributions from earlier years. But what I think is surprising is just how the vintage, say 22, 23, have just been incredibly low in terms of the distribution return, and how the headline and punchline there being that investors have not yet gotten all their cash back since the 2016 vintages. So we're still very much in that J curve, or at least locked in with private equity. And that is something that we're going to watch as we look at how private equity will fare as public equities experience such uncertainty. So that is our update for this week. As I said, it's been an interesting week in geopolitics. Just since recording this, or at least presenting these slides, we have seen the oil price tick up on the back of geopolitical tensions. A tense weekend ahead, it looks like, as we look for retaliation from Iran versus Israel. This was, it was definitely, it's become a hotbed of activity in the Middle East. And we will be looking to see to what extent it affects the oil price, as well as generally affects sentiment in markets. And look forward to checking in next week as we move even further into midsummer. Thank you very much.